Let's take it across to Nikunj. She's got Jayakumar, the MD at Prime Securities, for a chat on the markets. Nikunj?
And over a period of time, the macros have led to improving micros now. So the improving micros clearly indicated that a floor was put in place just below 10,000. And even on your show last, I think we called the fact that 4-digit Nifty would be difficult to sustain. So that's held out. But as we speak right now, the market's virtually climbed, 2/3 of the entire fall it has retraced. So the way I would see right now is, this is a very discerning market. So you have, for instance, there are stocks that hit 60 and 70,000 crore market caps that today are struggling at 10,000 crores. No price for guessing names, but where a good bull market is one where few stocks make new highs. People are still hunting for value. They are scared getting into the frontliners, and those that are throwing darts at the small and mid caps, which are hitting new lows with gay abandon. So in some sense, it's a very discriminating market, and it's a market that we should not confuse for a across the board bull market. It's a stock pickers market. Very, very clearly, make no mistake about it, it's a stock pickers market. It's a market where at some level you're swimming with the sharks. So you need to be clear that in the same space, there'll be stocks that hit new highs and stocks that hit new lows almost with equal alacrity. So from a market perspective, I think it's a fabulous place to be if you're a stock picker. Leave the Nifty alone, and going back to again our conversation of last time, you will have a scenario where public will be well served putting 50-60% of his portfolio in good index equivalent funds that will move up maybe 10, 12, 14, 15% a year. And it's not impossible. They may not go up in a linear fashion. And use the balance 30-40% for the mid-cap play. Because if you're otherwise going to be, if you're not a professional stock picker, then to be in the market, in this market trying to make money, whether trading or otherwise, is going to be very, very difficult.
Fair point. So I'm just going to first address pockets here. And since we are recollecting our previous conversations, we discussed aviation extensively.
Right.
And Indigo numbers are an eye-opener in a sense that the aviation sector may be growing, but crude is the biggest variable factor. I mean, I thought for a moment that it doesn't matter where crude is going because Indian aviation industry is enjoying pricing power. But for the quarter gone by, Indigo has admitted that, look, crude is important. Let's watch out.
Well, I think that's the subtext. If you see what has happened is, this sector has grown at a rate which is completely in dissonance with the way the economy is growing. Of course. It's grown at, in some months, 20-25%. Now, if you go back and figure out what's happened is that as capacities kept growing, the industry players kept prices at levels which were even comparable to, I mean, pardon my the bus ride between two, 2 points, as it were, definitely competitive with rail and significantly more comfortable, etc. So really what happened is that as now traveling by air, if you just take the experience, there is no airport which is today not chock-a-block. Airports are today catering to, a tweet the other day I saw which said that the Kanpur airport, for instance, catering to 4 times the load it can actually take. And in the morning, the queues actually lead virtually up to the car park. So if you look at those kind of anecdotal evidence, what you're basically saying is that along the way, crude kept going up, prices never kept getting passed, and what you're seeing in Indigo are lagged results. So without getting into the stock specific, I love the space because I think the pricing power has come in because traveling by air has become habit formation. Today, very, very few people will consciously choose anything other than air travel if that was available. So the way I see it is, results are a lagged indicator. Pricing power has returned. Now, I'll just give you one more thing. 10 years ago, we were traveling Delhi-Bombay economy at 8 or 9,000. 3 months ago or 6 months ago, we were traveling Delhi-Bombay economy at 3,500 and 4,000. Makes no sense.
Makes no sense.
Now, you go back to simple Make My Trip or any of these apps as of 1 month ago, rates are back up at 8 and 9,000. The pricing power has returned to my mind April, May, June. You will see significant revenue and yield increases, which you've not seen so far. And I think the growth will come down to 10, 12, 15%, but that's good. Load factors don't need to be at 98%. Just imagine, airports can't take more people, flights are going chock-a-block, aviation companies are doing 94 and 95% load factors. What has to follow is pricing power.
But Jakes, what we are today, making a view, what markets are making a view are based on Indigo's numbers for the quarter gone by. Yeah. This is April, almost May now.
So there's a consensus sell call today, right?
Exactly.
Which is exactly the time that good individual stock, and I'm not recommending, I think the aviation space To make entry into this, you need to get into this mass consensus sell calls. Those are the days when you need to make your entry.
Would you be happy to allocate 8-10% of your portfolio to aviation, maybe a combination of 2-3
Maybe
stocks?
even higher.
Maybe
it's a consumption, consumer-facing space. Become habit formation. Airports are growing, infrastructure is growing, and the air travel experience is fantastic. Airport today, people would be happily be willing to wait at an airport than wait at a railway station. So given that kind of a thing, where is the question? Don't look at 1 quarter numbers. And if in 1 quarter, a single company result can take it down by 20% or 25%, where else do you get good entry points?
Fair point.
And I want to make a disclosure, I don't hold Indigo. But I think the space, I own stocks in this space, and I don't want to talk specific stocks, and I love the space. Travel to the Far East, travel to Europe, travel to the US, travel anywhere. And some of the players you mentioned are well linked with people worldwide. So I think the Indian aviation space is well served by the Indian diaspora. And to that extent, I'm saying travel whether to India or travel out of India has grown dramatically. So, I'm saying within the country and otherwise. So these 3-4 players, and you haven't much to choose. So a portfolio which includes all three should be taken. And within the space, I think there are people who are focusing on cost, people who are focusing on capacity utilization, people who are focusing on better experience. So I think you have your pick here. It's still a young, vibrant industry, growing at, I would say, sustainable basis, 15-16%, with pricing power now coming back. To my mind, it's like to some extent, like some of the nascent industries which are consumer facing. So the multiples will grow. Of course, in this, some companies are priced to perfection, others aren't, and that's where you need to.
Okay. Who's buying into some of these consumer staple stocks? 3 years ago they were expensive. In the last 3 years they've become wildly expensive. HUL trading at a P multiple 50 plus, Titan almost reaching there. These are expensive stocks, and yet the price action is indicating that the buyers are still chasing these stocks.
So, I think the way I would address it is slightly differently. So, you will not find value here. You will find some normal growth. Buying into some of these stocks that you mentioned will continue to, there will be periods in time when they will be, quoting at 50-60 multiples. The largest retail company in India by market cap, you know the name.
Yes.
When it came out in the public issue, people thought it was expensive. It listed 50-60% higher, people still thought it was expensive. Today we're talking about 5x the listed price, and there are buyers galore. So I think it's a way, expensive stocks will remain expensive because as people drift to quality and polarize to, good managements, which is actually the play. So people are saying good managements, clean and transparent, we're willing to pay any price for, as long as fundamental underlying growth is there. So who is to say that 50p is expensive or 65p is also expensive? But who's to argue between 50 and 65? Once it goes beyond the 15-20 range, you tend to get into multiples that are really what the market is willing to bear.
But Jakes, markets are betting on a domestic recovery, a cyclical recovery. And typically when the bent of the market is tilted towards a genuine economic recovery led by capacity expansion and rural demand coming by, you would imagine that cyclicals should be toast of the town. But cyclicals are not doing all that well as markets were anticipating them to do.
See, I think the take here on this is that anything that is infra focused, because that's where the biggest action is. So we are very bullish, for instance, on the road infrastructure space.
Pure EPC companies.
Well, I would say a combination of EPC and toll companies. I think that combination, the activity around, you travel the countryside, that activity is there for everyone to see. And today with InvITs, etc. coming, these people are able to, in a sense, get debt off their balance sheets and deleverage themselves just as efficiently. So I think these companies will show growth, will show very good top line growth, and possibly with efficiencies coming in, managing number of toll roads, etc. I think they will show very good growth. So if those companies are not.
Okay, that's an exclusive chat with Jayakumar from Prime Securities and a whole host of sectors and stocks and how to approach the markets right now.